So I told you yesterday that since this is the case and it's just you and me hanging out today, that we would just go through some basic technical analysis. And so in the next segment, we'll start that. We'll spend the show just basically starting with a very basic S&P 500 chart, and we'll build a technical chart together.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. It is, of course, we're going to talk a little bit about technical analysis today. I've been promising you to do this for a little bit of time because, we talk a lot about technical analysis on the show, and, I get a lot of comments. It's like, you're always saying the market's overbought or oversold, and, what does that mean? And, and that's just technical analysis. That's all that is. And again, we have to make a clarification. We're not technical traders, right? So we're not jumping into markets, jumping out of markets, doing those type of things. What we use technical analysis for is two things. One, to understand the psychology of the overall market. Again, there's the market is all these buyers and sellers transacting business every single day. And some days you have more buyers than you sellers. Some days you have more sellers than buyers. And what technical analysis tells you is what is the, kind of the mindset of the overall markets. Technical analysis can also help us evaluate when there's too many buyers on one side of the boat or too many sellers on the other side of the boat. And that can point to potential opportunities, as I was talking about a moment ago with bonds. It can point to potential opportunities in a stock, in a market, where everybody's maybe gotten onto the wrong side of the trade, or because things eventually always reverse. Let me give you a couple of caveats here. First of all, I am not an expert trader of technical trading, and I don't profess to be. I've never professed to be. I am not a big technician by any stretch of the imagination. I have just developed over 30 years some basic kind of technical analysis that works for me, and and helps me navigate portfolios a little bit better over time by helping me kind of understand relative risk in the overall market. I try to just keep things very basic and very simple, because what I've found over time is that if I make things too complicated, that I start getting all different kinds of signals that confuse me, and they give me paralysis by analysis. Well, I've got these three indicators that say buy and these three say sell, so I don't know what to do, right? So I've just learned to keep, for me, and the way that we manage money for our clients, because we're trying to buy stocks and hold them longer term, right? So we use a very basic analysis. And again, you can get very complicated and very deep into, candlestick charting and Elliott wave theory and all these other things. And I'm not saying that they're good or bad. It's just, I don't use them that much because it becomes very complicated very quickly, and then I start not making good decisions for my portfolio. So I have found for us, and this is the way we do it, and again, whether you agree with me or not is simply, okay, that's a great thing about technical analysis. You can do it any way you want. I'm just going to show you how we do it, and if you're not familiar with technical analysis, hopefully this will give you a little bit of grounding and why it helps you manage your portfolio better over time. If you want to kind of follow along on the home game, you can just go to stockcharts.com and just enter a symbol in the top bar at the top for anything you want. We're using $SPX, which is the S&P 500 index for today's work, and you'll get a chart of it, and then you can kind of follow along with what we're doing. You'll have to contend with all the ads and stuff on the free version. So this chart, so let's just start with the S&P 500. It's just a basic candlestick chart of the S&P 500. So the way I got this chart was I entered SPX in the upper symbol, and then I changed the type to candlestick, right, which is your first option. And basically that's the standard setting that comes for this. And that's why we're using it. It's just a standard. You can use, there's all different types of charts. There's solid lines, dots, areas, histograms, all these type of things. Candlesticks, for our purposes, works the best. So just keeping it simple. As my dad said, you're stupid, keep it simple. Is that how it goes, the KISS principle? You're stupid, keep it simple, stupid. Well, he just called me stupid then. That's all there was to it. Or he was dyslexic with KISS. I'm not sure. He may have been dyslexic. I don't know. So what? Obviously, the market's. This is a 1-year chart, and the market's been doing fine for the last year, obviously, right? And so you go, well, Lance, just you don't really need technicals when you have that kind of chart. Well, you'll remember that back in April, we were talking about, hey, the market's very extended. You're going to have a correction. And we had a correction, right? And then in June, we said, hey, we're taking some money off the table. We sold down our mega caps in July because we were worried about a correction in the market that came in August, right? So, how did we know that, right? So there's a couple of ways that we can know that. We're going to go through about 8 different tools that we use over the course of the show. And that's once we go through these 7, 8 tools, you'll have all you kind of need to kind of do your own work. The first thing is just a simple moving average. And so if we go to overlays and we add in a simple moving average and we just want the 50-day moving average in this case, you'll see that it gives us a blue line that we can look at. So this blue line is the average price of the market over the preceding 50 days. So tomorrow, day 1 of that 50 of that price average will drop off, and today's price will be added on, and that'll be the new 50-day moving average. What this tells you, and is obvious by looking at it, is that the trend of prices over the last 50 days has been rising, right? And that's bullish. So when the 50-day moving average is rising, that's a bullish signal. Now, what we can also see, just visually by looking at it, we don't have to get real fancy with this. We can also see that on regular bases, the price of the market trades both above and below that moving average. That's why it's an average. You can't have an average if you don't trade below it every now and then, because that's how you get an average. So what you can kind of see is that the moving average is a bit like gravity. And, while the market can stay above the moving average for quite some time, eventually it reverts back to the average. And statistically, an average is called a mean. So when you hear the term reversion to the mean, that's what we're talking about. So markets right now, they're very elevated above the 50-day moving average. We should expect at some point that you're going to see a reversion back to the mean. Now, let's add a second moving average in here because there's something that we can learn from a second moving average combined with the first moving average. So we're going to add in a 200-day moving average, which is the red line. So now what we can see is that the markets are very deviated above the 200-day moving average, and they have been so for over a year. Now, what's that telling you, right? So right now you're going, that doesn't tell me much, but you'll do notice that just like the 50-day moving average, the market has tried to revert a couple of times back towards that 200-day moving average because that acts like gravity also. But again, it's a 200-day moving average. It is rising, which says that market prices, the trend of the market is higher. So we're in a bull market at this point. But to understand the importance of the 200-day moving average, I'm going to have to expand a little bit of the data here, and we're going to have to go back I'm going to go back 6 years on this data, just so that we can see where the 200-day moving average starts to give us a little bit better information technically. So now, in this chart, the blue line is the 50-day, the red line is the 200-day. You'll note that there are plenty of times that the market has reverted back to and beyond the 200-day moving average. What's important to note is when the market begins to trade below the 200-day moving average. So so if you're worried about a bear market, You're worried like, oh man, I'm really worried about, losing a lot of money in the markets. The 200-day moving average can tell you a lot about what's happening in the market and if that risk is prevalent. If the market is consistently trading above the 200-day moving average and it's rising, you don't have much to worry about in terms of a major market crash imminently happening tomorrow. Looking back at 2022, we didn't know at the beginning of 2022 that we were going to have basically a 20% down year in the market, but the market did fall. It traded below the 200-day moving average. The 50-day moving average crossed below the 200-day moving average. And then importantly, the market rallied back to the 200-day, failed, and then started to trend lower and traded below the 200-day. When that happens, that's a good indication you need to move money to more safe areas of the market. Because if you're trading below the 200-day moving average and that moving average is trending lower, so is the market. Now, obviously, that's not going to get you out right at the peak, and that's not our job. Our job is to try to mitigate risk on the downside. But you'll also notice that when the market started trading above the 200-day moving average and the 50-day crossed above it, if you just allocated back to the market at that point, you've enjoyed a very nice rally since then. So moving averages can help you navigate the bigger turns in the markets. When we come back, I'm going to add a couple of indicators to try to shorten those time frames a little bit to navigate the shorter term volatility of the market as well. Don't go away.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So if you're just joining us, we're just going through some basic technical analysis this morning. But we left off with our chart in the last segment with two moving averages, a 50-day and a 200-day moving average. And these moving averages are fine for managing your portfolio. If you're trading above the 50-day moving average, you don't have much to worry about. If you're trading below the 50 and the 200-day moving average, you want to be a little bit more cautious with your money. There are times where the market can trade below the 50-day moving average, and like we saw in April, and it's like, oh my gosh, we broke below the 50-day moving average. I need to sell everything, and you got to be real careful about that, because there are times that the markets can come down, test a moving average, break it, and then turn around and go right back up again. And so every break isn't necessarily the beginning of the next big bull market. And so we need a couple of other indicators to try to tell us if something is a more aggressive sell-off or if it's more of a buy the dip opportunity. And a good example of this was here just recently in September. The market came down, we broke the moving average, and then 2 days later we're right back above it. And this is so kind of our rule of thumb in our shop is this. If a market comes down and breaks an important moving average, that's an alert. We don't do anything. We're just, hey, we've had a break. The first thing is that we're looking for two actions after that point to confirm whether that break is important or not. The first is that the market rallies back to that moving average and then fails, turns down, and then takes out the low. So a good example of April is that, in September, is that we broke the 50-day moving average. We rallied back to the 50-day. And then if the market had failed there, taken out the low of that initial break, that would have confirmed that break is now valid and we're likely going lower. That's what happened in August. We broke the 50-day and the next day the market opened markedly lower. That told you that 50-day break was very valid and the markets were likely going to trend lower, and we did, and almost tested. We tested basically the 100-day moving average at that point, but the 200-day was approaching pretty quickly. Another good example was back in April. We broke the 50-day, rallied to it, failed, turned back down, right? And so there was certainly reasons for concern here. And then the market rallied, got back above it. So the second thing is that we want to see that break be confirmed by a weekly close below that break. So if you break on Monday, you don't do anything. If on Friday you're still below that moving average, might want to take a little bit of risk off the table. That doesn't mean sell everything, right? Don't go crazy when we're talking about taking some risks. We're saying take some profits, sell some laggards, those type of things. Just raise a little bit of cash. So always look after a signal is triggered, give it the rest of the week. If it happens on Friday, you give it till the following Friday. And so that gives you a little bit of time not to get whipsawed in a signal. Yes, the market may decline a little bit more, but it gives you a little bit of time to work through the signal and not get potentially whipsawed. Because what happens, and now I'm going to show you another indicator, and because this is what happens. When the market is beginning to correct, so let's go back and talk about April real quick. So the market back in April was doing fine. All of a sudden, we started going through this correction. Well, by the time that you break the 50-day moving average and you get down to a low, the market has already exhausted a lot of the sellers. So how do we know that? So there's basically two more indicators that we're going to add on to this for right now, and they'll kind of help with this. So what we're going to look at is relative strength. Relative strength is basically just the overall kind of momentum of the market. Is there are more buyers and sellers. Kind of what's happening is the price rising, is it falling? Relative strength can tell us a lot about the overall market. So and by the way, we're just using the basic settings. We have some proprietary settings that we use in-house, but we're just going to use the basic settings that you get on every site. So you don't have to try to figure out anything. The Relative Strength Index, RSI. Relative Strength Index, RSI. The standard setting for that is 14 days. So you're looking at the relative strength of the market over the last 14 days. And what we'll notice is, so let's go back and look at this. So the relative strength is on the bottom. And what you'll notice is that in April, when the market started selling off, relative strength was basically at 70. So if relative strength is 70 or above, that is overbought. If relative strength is below 30, it's oversold. So at or below 30, it's considered to be oversold. And so basically you've exhausted your sellers at that point. So you'll notice that when the market started to decline, by the time that we had already broken the 50-day moving average, we had already removed most of that overbought condition. By the time the market bottomed, you were very oversold. So again, what RSI can tell us is that is the market really, really overbought? Should we be a little bit more concerned and maybe take some profits? Or is it really, really oversold? Is there an opportunity? And so you'll notice that when the markets are very, very overbought, above 70, and that's where the RSI, that's these kind of green shaded areas, that normally equates to a near-term market peak. So if I get above 70, that's been a good place just to maybe take a little profit. So that's why you'll hear us sometimes say, hey, market's overbought, take a little bit of profit, because we're looking at overbought conditions that are telling us that things have gone a little bit too far, right? We just have had a really good run in the markets. And again, something's going to happen. And this is where the rationalization begins in the markets. We always try to find something. It's like a headline comes out and IBM lays off people or whatever, and then we say the market sells off. And say, oh, well, the market sold off because of that. No, the market was already in a position where you had the potential for a sell-off. It just needed a catalyst to get somebody to hold up their hand and say, I sell. Relative strength is one of those indicators that can kind of help us gauge when markets are really, really overbought. Now, we can get, there's a lot of things we can get into about negative divergences and these type of things. I'm not going to go there today because it's not that necessary. But what you can tell is that when we're very, very overbought, like here, another good example, in July, we were talking about taking profits and reducing some of our exposure in our portfolio because markets were exceedingly overbought. We were approaching 80, actually over 80. in July. And then, of course, we had the correction into April. And then at the April lows, we started talking about, the August lows, we started talking about wanting to add a little bit of exposure because, again, we had gotten very, very oversold, just like we did back in April. So this is just kind of one of those indications when markets are declining can help you not panic so much. And you'll notice two things. Markets can remain overbought for quite some time. They don't stay oversold for very long, right? So we can go back and let's just expand this back, just say 3 years here real quick. And you'll notice, again, that the bottoms occur fairly quickly. They don't stay oversold for very long. So when you're getting down to below 30 or at 30 in a lot of these things, that typically denotes a very short-term bottom in the markets. At least you're going to get a rally. You can stay overbought for a little bit of time. And as you notice in early 2024, the market just kind of hung out around 70 for a while and then eventually kind of gave up the ghost. And that's so now we need another indicator. How do we know the difference between the market's just going to hang out in overbought conditions or if we're actually selling off? Well, that's where we want to start looking at something that can kind of give us a relative buy or sell signal. Now, before we get to that, which we'll do here in just a second, I just want to make this caveat. No signal is perfect. Nothing is going to work 100% of the time. This is the big trap that investors get themselves into with technical analysis. Like, well, I tried it and it didn't work. It's not going to work every time. Markets are dynamic, and the herd mentality occurs and can keep things elevated for a lot longer than you think. They can keep things oversold for a lot longer than you think. So technical analysis isn't always perfect, and that's not the goal of using technical analysis. The reason that we're using technical analysis, and when we come back, we'll wrap this up, is just to try to minimize the risk to our portfolios by being on the wrong side of the trade when it goes in the other direction, because being bullish is easy. Markets are rising most of the time. So as long as you're invested, you're going to make money most of the time. What we're trying to avoid are those downturns that we have to then try to make up, because that's not the same as making money, getting back to even. So we'll come back, we're going to add one more indicator, wrap up our conversation on technical analysis. I hope you're finding this helpful. If you are, please hit that like button for us on the website today. We certainly appreciate it. Be right back after the break.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So we're talking just the basics of technical analysis and how we use it in our portfolio management just to mitigate risk and to try to navigate markets. Nobody knows what the market's going to do from one day to the next. If anybody tells you it's like, oh yeah, the market's going to do this next year, nobody knows. Everybody always says, this is what's going to happen next year, and then something else happens. Technical analysis is just your navigation tools, like a roadmap or anything else. It just helps us see what the market's doing on a kind of a real-time basis, what the market's thinking, what the market's believing. And then we can help kind of decipher and determine kind of what actions that we need to take. So we left off in the last segment. We've been building a chart slowly this morning of the S&P 500 with a 15 and 200-day moving average, and we've added relative strength. So we now have a couple of indicators here, but we need something that kind of gives us a buy or sell indication. Again, we have kind of a market, analysis here that tells us if it's overbought or oversold. Are we deviated from long-term moving averages or not? And those are certainly warning signs. When you have big deviations, eventually markets are going to correct back to those deviations and beyond that. So the question then becomes, well, I need a buy or a sell signal to kind of go along with this to kind of give me a kind of a warning sign that I should be looking to buy something or maybe to sell something. So what we're going to add here is just what's called a moving average convergence divergence indicator. So it's MACD. So if we're using stockcharts.com as an example, I just scroll down the list and I find MACD. All right, so this is just shorthand for moving average convergence divergence, and it is exactly what it says. Are two moving averages, are they getting closer to each other, or are they getting further away from? Are they converging, or are they diverging? If they're diverging, that's bullish. If they're converging, that's bearish, because it suggests that momentum is either increasing or slowing down. If moving averages are diverging, if the shorter term moving average is rising faster than the longer term, they're diverging, that's because markets are rising fairly quickly. If they're converging, that means, and the shorter moving average is getting closer to the longer term moving average, that says momentum in the market, price momentum is slowing down. So it kind of gives you something to work off of. So we're using the standard setup. It's a 12-day moving average, a 26-day moving average, and a 9-day signal line. So I'm going to add this to our chart, and we can now see this. Brent's going to have to kind of zoom in. Our chart's getting a little bit too big. So what this moving average convergence divergent indicator tells us is that one, if it's very elevated, that markets have had a very long run, and that you're starting to get to a pretty overbought state of the market. If it's a very low level, below zero, then that's typically normally where bottoms begin to form in the market. But so all that it kind of is and you'll note that it tracks very closely to RSI in terms of its overall shape. So it also kind of acts as an overbought, oversold indicator, but that's not really what I'm looking at for this. What I want to know is whether or not moving averages are beginning to show signs of a pickup in momentum, or prices of the market are picking up in momentum. Now, the problem with the MACD is that it can flip back and forth sometimes. And so you kind of get false signals from time to time, and you have to be a little bit aware of that. And so again, this kind of goes back to our rule that when you get a MACD buy or a sell signal, we give it a little bit of time to confirm that it's a valid signal. And a good example of this is coming out of the April-May sell-off. You'll notice that the MACD, kind of flipped to a sell signal real quick, and then it went back to a buy, then it went to a sell. As it was climbing higher, it was kind of flipping back and forth. Well, two things kind of told us that those initial signals weren't valid sell signals, because when we got the initial sell signals, the markets weren't exceedingly overbought yet. Momentum was positive. We were trading above the 50-day moving average, and there was no real sign of concern. We got this little short-term sell signal. The market did correct. You'll notice that the market did correct here a little bit, pulled back to the 50-day, and then that was kind of a buying opportunity, right? We came back to the 50-day, held that support, held it through Friday, and then we triggered back onto a buy signal. So if you were needing to buy something, that was kind of a buy the dip moment. But we never had something that said, hey, we need to sell and get out of the market. However, in June and July, this is when we started kind of ringing alarm bells that we needed to reduce exposure to the market at that point. And we needed to be a little bit more cautious, because now we had an elevated MACD signal with an elevated relative strength index. So when we got that sell signal in late July, again, this is, remember, the yen carry trade blowup didn't happen until early August. So the MACD was already telling us that, hey, we need risk reduction here to some degree. And that was before the yen carry trade blowup happened, and then the market sold off. So right now, we are once again, and we are back to fairly overbought conditions. And momentum in the market over the last few days is slowing, and we are very close to triggering a MACD sell signal from a fairly high level. Does this mean the market is about to have a major correction? We don't know yet. What this tells us is that we may be getting closer to a period. Again, we've had 6 straight weeks of advances. Markets are very overbought. an election outcome we're not prepared for could certainly lead to a bigger sell-off in the market. So we're going to be watching that MACD sell signal pretty closely. And if it occurs and confirms with a market decline, then we're going to start reducing risk a little bit more aggressively. But this just kind of helps us kind of navigate through this. Now, again, signals are not foolproof. And again, as we go through these things, you'll note that, well, there's periods where you just kind of flip back and forth and the market just kept going up. Yes, that happens. And that's where it becomes kind of challenging with markets. But as long as markets are trending higher, and there's some other things that we could add to this. One of the things that we look at and we kind of keep, on most of the charts that I show you during the week is we add a 20-day moving average, which is a real short-term moving average. And you'll note that when markets are rising and you're having these signals kind of flip back and forth, that the 20-day moving average kind of acts as trend support for the market. Again, you'll kind of see this green line now that I've just added very quickly, that just kind of adds a little bit of analysis. It says, well, as long as we're holding the 20-day, and even though the MACD sell signal is flipping back and forth, as long as we're holding that 20-day moving average, I really don't need to worry too much. Now, if we break the 20-day and get a sell signal and relative strength is declining, now I need to pay more attention. So I want to end there. You don't need to get more complicated than that. There's a few other indicators that we talk about. We talk about Bollinger Bands, which measure standard deviation from means. Those are important. We talk about Williams %R, stochastics. Those are also other overbought, oversold indicators that can be used. And again, with this, though I don't need to get drastic, with this just kind of basic setup, I can do some basic technical analysis and try to navigate the market a little bit better. Now, these are daily charts. Now, I just wanted to also note that weekly and monthly charts can also be very important to navigating markets. And the reason is that monthly charts tell us more about trends. They're terrible for trading because in the short term, monthly charts don't matter until the end of the month, but they can tell us a lot about the overall trend of the market. So if you're worried about the next big major crash in the markets, then that is something that you want to also kind of take a look at, is look at a monthly chart of markets over time, because it can kind of help you navigate some of that risk, I guess, of avoiding a bigger correction. And so, for instance, here's a monthly chart of the S&P 500. And all this is a relative strength index on the top, the chart itself, and on the bottom is the MACD. You'll note that there are very few periods going back historically where we are this overbought and this extended on a MACD and did not have a much more significant correction in the markets. Now, that doesn't mean today, doesn't mean next week, next month. This is a monthly chart. It could be a year or two before we get to that point. You have exactly the same setup right now on gold, which is extremely overbought, extremely extended, extremely deviated for long-term means. Doesn't mean it's going to correct today or tomorrow, but historically, whenever you have this set up, you've had long periods of consolidation or correction in prices. It's just what the technicals tell you. And you can go through any chart on this. So if you're a long-term investor and you're really kind of worried about downturns in markets, you're really trying to avoid that bear market, a monthly chart can help you get a better fix on how that could potentially play out, but it's terrible on timing. Daily and weekly charts will give you a much better analysis of how to navigate the markets near term, right now, for the next several months, into the end of the year. That'll help you. I hope this analysis on technical analysis helped you out. Be sure and hit that like button for us if you enjoyed it. Appreciate your time today. See you back here tomorrow.